In this video, you'll learn how banks control the value of your money. If somebody asks you today why you are keeping your money in a bank and not under your mattress at home, your response will be something like this: my money is safer in the bank. And that is correct. We use banks to store our money because they are the safer alternative, and because banks give us a little extra for keeping our money in fixed savings accounts. But there is something else that happens when we give banks our money. We lose control of what we can do with it. So, before we learn how banks control and manipulate money, take a moment to like the video and subscribe if you are new. Now let's dive in. In the famous Spanish TV show Money Heist, a group of daring bank robbers break into the Royal Mint in Madrid. Their goal is to print over 2 billion euros. According to their leader, El Profesor, they argue that this is not stealing from anyone. It is new money, not money taken from someone else's bank account. This is exactly what the world's central bankers have been doing legally for decades. Although they haven't literally turned on the printing presses, and certainly not at gunpoint, in recent years, central banks around the world have been creating money on a scale that would make even our Hispanic bank robbers blush. Since the 2008 global financial crisis, the Bank of England, for instance, has printed nearly £1 trillion in new money and released it into the economy. The US Federal Reserve, on the other hand, has printed over $7 trillion since the 2008 financial crisis. Now, if you are wondering, why can't central banks just print enough money to save me from the rising cost of living? Sadly, that's not how it works. See, while central banks can legally print money, they can only do so when it's extremely necessary. The 1980s marked a period of remarkable growth for Japan, transforming it into a powerhouse of global capitalism. This era saw Japan excel in producing everything from cutting-edge electronics like Walkmans to automobiles. However, the early 1990s brought a dramatic change as the economic bubble popped. This led to a deceleration in the economy, triggered by reduced spending from both individuals and businesses. As spending slowed, inflation also fell, a direct result of reduced demand leading to stagnant price growth or even price drops. Faced with this challenge, the Bank of Japan was tasked with stimulating the economy and raising inflation in the economy. The objective, like that of most central banks, was to maintain price stability, which would reflect a balanced level of spending throughout the economy. However, the big question was how the Bank of Japan would accomplish this. Like its global counterparts, the Bank of Japan operates by influencing the cost and availability of money in the economy. In the 1990s, the primary tool for injecting money into the economy was through adjusting interest rates. You see, central banks hold an important role as they are the banks to other banks. They have the authority to set the terms for lending to these banks when they require money. Similarly, they can determine the interest rate paid to other banks for deposits held with the central bank, much like how your personal bank operates with your deposits. This control over interest rates is a crucial mechanism for central banks to manage the money flowing in the economy and its health. When central banks change these terms, it has a series of effects on the rest of the economy through channels that guide how money circulates in the economy. First, by changing the rate they charge and pay to other banks, central banks motivate those banks to change the rates that they charge borrowers and pay to their depositors. That said, banks compete against one another to offer the best rate and attract customers. When the central bank switches its interest rate, it is more or less expensive for banks to offer deposits and lend. This means they either need to pass on any cost changes to their customers or lose out to competitors who will. Eventually, the central bank's rate feeds through to a whole range of interest rates in the economy, from credit cards to bank deposits and business loans to savings accounts. This, in turn, affects people's economic behavior. Interest rates influence whether you should spend now or save now and spend later. Say you had $100 now, but if you stored it away, it would turn into $110 next year. And since there's not much in it, you might choose to spend it now. But what if someone told you if you didn't spend it today, you could have $200 next year? Would that shift your decision? Although an extreme example, this example sheds light on how interest rate works across an economy. Higher interest rates motivate people to save and discourage them from spending or investing. When interest rates go up, more people save, fewer people spend, fewer businesses invest, and the economy slows. On the other hand, lower interest rates discourage people from saving and encourage people to spend, in the process boosting the economy. Secondly, interest rates are linked to the value of assets in the economy. These might be financial assets such as stocks or physical assets such as houses. When interest rates go down, the prices of these assets tend to go up. That means people holding assets are better off. And when people get richer, they tend to go out and spend some of their increased wealth. A good example is people borrowing a bit more when the value of their house goes up, then spending it. Thus, a reduction in interest rates can lead to a boost in overall wealth, which subsequently translates into increased consumer spending. Thirdly, the concept of income effects, as understood by economists, plays out differently depending on whether you're a saver or a borrower. For borrowers, reduced interest rates translate to lower monthly payments on loans like mortgages. This effectively leaves you with more disposable income in your pocket. Naturally, with more disposable income, you're inclined to spend more, which in turn stimulates economic growth. Conversely, for savers, lower interest rates mean lower earnings on their savings. And with less disposable income, this leads to lower spending. It's important to note that many of us wear both hats. We save money in bank accounts while also managing debts like mortgages. Therefore, the net effect on your personal finances depends on how these two aspects balance out. When considering the broader economy, the impact of these income effects hinges on the relative proportions of savers and borrowers and how each group adjusts their spending in response to income changes. If savers and borrowers were equally responsive to changes in their income, their opposite reactions could potentially neutralize each other, leading to no significant change in overall spending. However, economic trends suggest that borrowers are more likely to increase their spending in response to more income than savers are to decrease theirs due to reduced income. This implies that generally a decrease in interest rates tends to encourage overall spending in the economy. This phenomenon is crucial in understanding how central banks use interest rate adjustments as a tool to manage economic activity. By lowering rates, they aim to encourage borrowing and spending, especially in times when the economy needs help. This strategy can be particularly effective in stimulating sectors like consumer goods and real estate, where increased spending can have a ripple effect, leading to greater economic growth and stability. Fourth, there is a group of channels that work through the banking system itself. When interest rates are lower, banks can offer loans to people more cheaply, so the amount of lending in the economy tends to increase. There is more demand for loans as people look to borrow to fund their spending and investment. At the same time, banks are more willing to lend, not least because the cost of issuing and maintaining a loan is lower, and people have more valuable assets to offer as security thanks to the increased wealth. An increase in lending boosts the money supply and also boosts economic activity by allowing people to spend and invest. All of this leads to increasing demand and so an increase in inflation. Lastly, when central banks lower interest rates, this tends to lower the exchange rates. For example, the sterling pound falls in value when UK interest rates fall. If the interest rate in the UK goes down, but the interest rate in the US doesn't, then you are going to get a relatively better return if you switch your money out of pounds and into dollars. So money flows across borders, and more people want to buy dollars and sell pounds. This shift in demand means that the price of switching from pounds to dollars changes, making it more expensive to buy dollars with pounds. This in turn pushes up the prices of imports, consequently raising inflation. Well, there you have it. Thank you so much for watching. Have a great day, and see you in the next one.